I'm Alan Kinney, Managing Editor of REIT.com. Joining me is Bill Scapell, Director of Fixed Income for Cohen & Steers. We're going to discuss the ins and outs of preferred securities for REITs in the current market. Bill, thank you for joining us. Do you think the REITs are going to be issuing more preferred securities in 2011?
Preferreds make a lot of sense. They're perpetual instruments, so you don't have to worry about refinancing, and they're quasi-equity. In addition, they help companies, lots of companies, but in particular the younger companies, in terms of their balance sheet management, insofar as this is borrowing that isn't attaching assets. It's unlike secured borrowing, which can affect your debt covenants and your bank covenants.
Bill, what makes preferred securities so attractive to certain classes of investors?
The historical risk and reward of investing in REIT preferreds has been very, very good. And that is supported in part by the very high income rates that REIT preferreds have, and the fact that they pay that income quarterly. If you buy bonds, you get paid semi-annually. With REIT preferreds, you get paid quarterly. And this very high and regular income smooths the total return equation because you have a reinvestment and a lot of income coming in. So if you look at them on a risk-adjusted basis, they've been just great investments.
You've written a little bit about the privatization risk for REIT preferreds. Can you tell us some more about this?
In the 2005-2006 context, when many REITs, as you know, were being privatized, in that time frame, we saw many companies become privatized and leave their existing preferreds outstanding. So what that did to the investor in the REIT preferreds was effectively made you a mezzanine investor in a private company. That generally had much higher leverage than the company that was its predecessor. And of course, your preferreds become delisted because private companies won't list on the New York Stock Exchange. So the liquidity is very poor as well. And in effect, what occurs is you've really been you crammed down.
So then how can underwriters and investors address these risks?
What's important here in terms of the protections is that we need to preserve the equity nature of these securities in order to make them work for the REITs. Our solution to this is one that we borrowed from the world of convertibles, and effectively would give the holder an option to convert into shares in a ratio that effectively makes you whole relative to an LBO.
For more information on this and other REIT news and analysis, check out REIT.com.